Hey, good morning, Vanessa.
Morning.
Chapter 10, huh?
Yep.
We're skipping 8 and 9, saving the two payroll chapters for the end.
Okay.
How you doing with the bank reconciliation homework? Okay.
Yeah.
Okay.
I feel like I think it was chapter 6 that did me in, or five or six, and then after that, I feel like I'm on a roll.
Okay. Yeah, I guess it hopefully gets a little bit easier.
Yeah.
And this is not Brooke. This is Cameron. Is that right? Yeah. Okay. Two people, huh? Let's wait another 30 seconds or so, and then we'll get going. This is a fairly quick chapter. There's Mark. Hey, Mark.
Hello, Professor.
Good to hear from you. Good to see your moniker up there. All right, I guess we can get going then. We got three people. We're not drawing the same crowds we were earlier in the class, huh? So with that in mind, let me share a screen with you. Somebody please verbally tell me they can see the PowerPoints.
Yes.
All right. All right, off we go. In this chapter, we're talking about recording sales, sales at the retail level. We're going to talk about sales and cash receipts a little bit, and we'll get going here. Merchandise sales transactions. We know that a merchandising operation buys and sells a product. They don't make the product, they buy it and they sell it, like Nordstrom's, like Target. Merchandising business, they purchase from vendors, suppliers, and they sell that stuff to customers. And a sale is a transfer of merchandise from one party to another in exchange for some consideration, usually cash. The retailer, that's the store. The retailer is the store that sells to the end user. This is Target. This is Nordstrom's, Macy's. They sell to the final customer. And there's typically some kind of paper trail, a cash register receipt, tape summary, a sales ticket. You may or may not get one of these in terms of a hard copy, but you'll certainly have that available online. And they're showing us a sales ticket, otherwise known as an invoice. I don't think we're too interested in that. The wholesaler is the middleman. So make sure you're clear on the wholesaler versus the retailer. The wholesaler buys in bulk and then sells and ships to the stores, okay? Wholesaler, these are the people Costco buys from. They purchase the merchandise from the manufacturer and they sell to the retailers, and they're saying usually on account. I'd say always on account, huh? A sales invoice gets generated, and then the copies of the invoice can go to different parties depending on what the company's policies are. One, obviously, copy goes to the customer. Accounting certainly is going to get its hands on all the invoices, and one copy of it might go out with the merchandise, and there could be other copies that float around for different reasons. Wholesale transaction process. You create a purchase order, which we'll get into in the next chapter. You create a purchase order. You check the customer. You check the customer out for worthiness. Customer purchase order. Let me be clear. The customer sends you a purchase order, which says, I want to buy $1 million of this particular product of yours. Well, you're not going to sell them anything until you approve their credit and verify that they're on a sound basis. And then those 3 copies of the invoice go out, including one with the merchandise. And there's an invoice. We all know what an invoice looks like, huh? 6 items of something at 30, 5 at 400. Notice there isn't any sales tax on that particular invoice. They might be in Texas or Oregon or Nevada. A credit memo, let's talk about this a little bit. A credit memo was used to be more important when everything was done in pen and typewriters. A credit memo was simply permission from the seller to let the buyer return something. That's all. It used to be you would call up the company and say these parts are defective. I'm going to return them tomorrow. I'm just letting you know. And that party would then say, okay, here's a credit memo number, and you can use that as you wish to get a cash refund or get it in merchandise. Okay. So we're going to talk about two new general ledger accounts in regard to these types of activities. A sales return, merchandise return for a refund, sales allowance, price reduction granted by the seller for various reasons. Customers return goods all the time. It's a normal part of business. Sales allowance might be you bought a toaster for $50 and you don't really like it that much, so you decide to return it. But the seller says, why don't you keep it and I'll drop the price to 30. That would be an example of a sales allowance, perhaps. So your credit memo is just permission to return something. And the credit memo is going to look exactly like the invoice, except the numbers are going to be minus for the most part. Okay. Now we're going to go merchandise sales accounts, huh? Take a look at some new accounts you're seeing. You're seeing these for the first time. To account for merchandise sales transactions, we have 5 new accounts, huh? Well, they're calling sales a new account. I guess we've been calling everything revenues up to now. Revenues is a more generic, overall sweeping term for income. Sales are just that, sales of your product. So we're going to credit sales whenever we sell something. We're going to have sales tax payable if there's sales tax involved, and that's going to be a liability to record. Sales returns and allowances. We're skipping customer refunds payable deliberately, and sales discounts are the two we're going to talk about now. Sales, returns, and allowances. So take a peek here at your new spread on the accounting equation. You have sales, which are a credit balance, right? Sales, we know that's a credit balance. All revenues are credits. Notice the sales returns and allowances and the sales discounts have a debit balance, These accounts are called contra accounts, similar to accumulated depreciation. These contra accounts are contra sales account. Every contra account is married to a master, let's say. And so sales has 2 contra accounts you're learning so far: sales returns, allowances, and sales discounts. Okay. When something is returned, we do not debit sales. And I'm going to say this over and over again. You never debit sales. You never debit sales. Never. Keep that in mind. What you do debit are the returns and allowances or the discounts, depending on what's going on. Companies want to know what their total sales were, but they're surely interested in how much is being returned, what kind of allowances they're handing out, and whether customers took discounts. Sales account, it's a revenue account. As we know, it's credited as a credit balance. If a $100 sale is made for cash, we debit cash and credit sales, or we debit accounts receivable if it's on account. The sales account is credited even though we haven't been paid yet, right? The cash movement is independent of when we might record the income. All right. So that's pretty much what we learned in chapter 3. We're going to debit cash, credit sales. Sales tax payable. This is a liability account, okay? This is not the company money. This is a part of the payment we received from a customer. It's a liability account used to record the taxes collected on sales and owed to the taxing authority. We, as the seller, have a duty to turn this customer money over to the state at the appropriate time, okay? In California, it was the famous DE3 form, I believe, where you would gather up your sales tax information and send the appropriate check to the state. Most states require retailers to collect sales tax on sales to final customers. Keep in mind, the only people who pay sales tax are the end users of a product, typically meaning us, the public. When we buy a product from a supermarket or a store, we're the end users. So it's at that point that the sales tax is rendered. When the wholesaler buys millions of dollars worth of toilet paper for shipment to Walmart, there's no sales tax involved. So I'd like you to keep in mind that only the end user pays sales tax, okay? And that's going to be credited when we make the sale. Make the sale, and when we pay the bill, we're going to debit that account, okay? So take a look at sales tax payable. This isn't too tough. If a cash sale for $100 plus 5% sales tax occurs, the following entry is made. So let's take a peek. We debit cash for $105. The sale was only $100. The sales tax is a different number, sales tax payable. So this sales tax payable number is going to grow. And at the end of the month, this company must pay the state the sales tax they've collected from customers. And they're just showing you, they're just showing you can be a cash sale or on account, okay? I think we know that. Sales returns and allowances. Let's get familiar with this. A contra revenue account used to record sales returns and sales allowances. It has a normal debit balance, and it's shown as a deduction from sales on the income statement. This account is debited rather than sales so that the business can more readily keep track of this type of activity. You never debit sales. I used to bring the guitar into the classroom and annoy the class, singing, "You never debit sales." You never debit sales, never. What you do debit are the contra sales accounts, one of which is sales returns and allowances. So here we go. Refer to the credit memo. Okay, it was a credit memo involved here, big deal. We got permission to return something. We're returning a riding helmet, okay? Or rather, we gave our customer permission to do it. We're the seller. So the customer is returning a $46 item. The sale amount was $46. We now know you never debit sales, but you do debit sales returns and allowance, and we have to pay back the sales tax. So we debit the sales tax payable, and we credit the accounts receivable for the $48.30. So this entry is now taking the accounts receivable off. They don't owe us the money anymore. We're giving them credit for $48.30. We're not going to talk about the sales returns timing differences. Sales discounts. Let's have a little fun with this. We now know what sales returns and allowances are all about. Sales discounts account. Again, it's a contra revenue account used to record discounts given to customers who buy merchandise on account. Businesses offer cash discounts to encourage prompt payment. This is not a discount where you go into the store and there's something that's normally sold for $100 and today it's on sale for $70. So you're getting a $30 discount. No, that doesn't get recorded in your financial statements. That just means you paid $70 for something. That's called a trade discount. Cash discount is totally different, and we're going to talk about it in a little detail. Businesses offer this discount to encourage prompt payment. Prompt collection of accounts receivable reduces the risk that receivables will become uncollectible. And again, sales discounts is a contra sales account, meaning it has a debit balance since we never debit sales. And you're going to see it right on the income statement like that. Let's get familiar with these terms. Typical credit terms. Now, when we're talking a sales discount, we're talking about the type of discount companies offer in order to get their customers to pay earlier. 210 net 30. You see that first one there? 210 net 30 is how that reads. 2% discount if the customer pays us in 10 days. Otherwise, they pay the net amount, full amount in 30 days. 2% discount if they pay in 10 days, the net otherwise. 210 net 30. That's a very typical one. It used to be anyway in the workforce. You could have 110 net 30. You could have 2 end of month if they pay by the end of the month. Otherwise, they have to pay in 60 days. You know, they're unlimited, the amounts of types of discounts that you might give out. If a seller is offering you a 2% 1030 discount in today's world of terribly low interest rates, you would be nuts not to take that discount. You take that 2% discount, it's the equivalent of 37% a year. In other words, if you got your money, you're giving up the money for 20 days and you're going to earn 2% in 20 days. There's, say, 360 days in a year, roughly. You divide 360 days, every 20 days, that's 18. You're doing pretty darn good. So the credit terms we need to know. Sales discount journal entry. Here we go. Well, let's see. We sold something for $100 on account. We debit accounts receivable and we credit sales. Not too bad so far. Now the customer has returned it in exchange for your cash refund. Okay. Well, I'm sorry. Forgive me. I'm going off track a little bit. Now the customer has paid the bill. We debit cash, but we're only going to get $98 because the customer took the 2% discount. So accounts receivable was $100. And now we're taking that $100. Hold on one second. Let my buddy drive by. Hey there. Customers now paid us. They owed us $100. That comes off with a credit. We debit cash for $98, and we debit sales discount, which is the contra sales account. Now they're going to talk a little bit about the accounts receivable ledger. You already know how to post things to the general ledger, the T accounts. We're talking about the glorified T account known as the general ledger, accounts receivable ledger. And here they're giving us 5 or so transactions that are all the same. A sale on account plus sales tax. So we sold something on April 4th to Enrico, and then we sold things to Brenda, Edith Walton, Wilma Cruz, and Heidi Schweitzer. Okay. So the sale amount for Enrico is $15.20. That's going to be the credit to sales. The $76 is going to be the credit to sales tax payable. And the AR number is going to be the total of those. Let's take a peek here. Okay, on this particular grid here, you've seen one, you've seen them all. We debit accounts receivable for the entire amount of cash that we're going to collect. The sales amount is broken out just for sales and sales tax payable. The sales number on any transaction is always going to be the number of units sold times the price per unit. There's never anything mixed in to the sales number like that. So that's always going to be a multiple of the product traded. And Brenda Myers, the same thing, 462. So get familiar with this. We're going to debit accounts receivable. We credit sales for an item that we sold for $440. And the difference of $22 is your sales tax, okay? Let me move this down a little bit. Now they're just going to talk about posting to the general ledger. And this is a review from earlier chapters. In the general ledger, you put the date and the amount of the transaction and the new balance, right? General ledger, you enter the date, enter the amount of the transaction, and bring up the new balance, and maybe number the page. In the journal, enter the ledger account number in the post reference column. Well, here we go. And again, this is something you should be pretty comfortable with, I hope. Here is your journal entry. We debited sales for Enrico, $15.96, credited sales for $15.20. And what they're showing you here is they're just bringing the numbers down to your general ledger. Here's your general ledger. Accounts receivable, well, let's see, that's the $15.96. That goes here, that's a debit. Sales tax payable was $76, and the sale was $15.20. So look at what we have here. This is your general ledger. We're showing both the transaction and the new balance in the account, the very definition of the general ledger. General ledger is a glorified double T account, okay? One for the transaction, one for the final balance. So let's continue. Now, we posted to the general ledger. We are now introducing what's called a subsidiary ledger. Subsidiary. Many of your asset accounts are backed up by what's called a subsidiary ledger. Accounts receivable, you're going to learn, has an aging to it where all the customers are listed. They show how much is 30 days overdue, 60 days. Fixed assets could have their own subsidiary ledger, but accounts receivable and accounts payable certainly do. The accounts receivable ledger contains the individual accounts receivable for each customer. Okay, the accounts receivable ledger is going to show in T account general ledger type form what each customer owes you at any point in time. And they're saying each customer gets an account number. Yeah, it's probably true. A summary accounts receivable account maintained in the general ledger is the controlling account. Cash is a control account. Accounts receivable, control account. Anything that comes directly from the general ledger is called a control account. So here we have a subsidiary, meaning below the hierarchy, okay? Your auditors are going to come in. They're going to look at the general ledger. And the general ledger says, well, we have $1 million worth of accounts receivable, Mr. Auditor. And the auditor will then say, please show me your subsidiary ledger. And then now that means the auditor can see all of the activity limited to these particular customers. And the auditor can make his selections on what he wants to do in terms of testing or contacting customers. Posting from the general ledger to the accounts receivable ledger. If you already know how to post to the general ledger, you certainly know how to post to the accounts receivable ledger. So let's just look at it and talk about it a bit. In the accounts receivable ledger, you put the date and the amount and the new balance. That sounds familiar, right? That's exactly the definition of posting to the general ledger. Now we're taking that accounts receivable number, that control number of $1 million, and we're going to break it out now by individual customer. Okay. So let's see here. Let's see. This is now, here we go. Make it a little bit bigger for us, bigger for me anyway. Here we go. Here are the same two transactions that we posted to the general ledger. Okay. Look at your accounts receivable subsidiary ledger. Okay? Enrico bought something for $15.96. That gets posted to his account. Apparently, he did not have a balance with us, and now he does, $15.96. Brenda Myers, she purchased $462 worth of goods from us. That becomes a debit on the subsidiary. And guess what? At all times, the total balance of the subsidiary must equal the balance of the control account. If it doesn't, you got big troubles. The total of the accounts receivable ledger must equal the balance in accounts receivable, which we now know is called a control account, okay? Accounts receivable control account. So if we look at it one more time, you've got the date. You might have some kind of posting reference, and then the debit. When these guys make the payment, that's when we're going to credit it on that side, okay? Relationships to remember. Relationships to remember. Entries in the general ledger are posted to the general ledger and the accounts receivable ledger. They must be done pretty much at the same time. After the posting of the accounts receivable ledger and the general ledger is completed, total of the accounts receivable ledger balance should equal the AR balance in the general ledger. I would be hard pressed to think you'll ever go out of balance with a modern computer system. If you're working with QuickBooks or Mass 90 or Oracle, the bigger ones, the smaller ones, they'll force you to make these entries. You're not going to post anything out of balance. The accounts receivable ledger is the detail. The detail listing of the same information that's summarized in accounts receivable in the general ledger. Accounting for sales, returns, and allowances. Well, we never debit sales, never. So we have a customer here named Wilma Cutts, and she returned merchandise that was sold for $46. And we got to give her credit for the sales tax. So we're going to reduce her accounts receivable with a credit, $48.30. And of course, it's going to get posted to the general ledger. We're going to credit AR. We're going to debit sales tax payable and debit the sales returns and allowance. We do the same thing with the AR ledger. Her balance was $651. Now we're giving her credit for $48.30, bringing her balance down to $602.70. Credit card sales are cash. Credit card sales are cash as far as I'm concerned, okay? Similar to cash sales, cash is available as soon as that deposit is made, certainly by the end of the day, okay? Some books say you set up an account called credit card sales receivable for those few hours where you don't have access to the money, but I think that's nuts. Credit card sales are cash. Cash is available to the business as soon as that deposit is made, okay? The credit card company makes electronic deposit to merchandiser's bank account for the gross amount of the sale less a processing fee. So let's think about that. When I go to 7-Eleven every day for my bottle of whiskey, they charge me $2.50. But I charge it on my credit card. So 7-Eleven does not get $2.50. They might only get $2.40 because Visa takes a point or two away from the seller. And the fee is based on the gross amount of sales, including the sales tax, which is interesting. In other words, if you have a credit card deal and you sell something and they get 5% of what you sold. That includes the sales tax. So if you sold something for $100 with a 10% sales tax, that's $110 total. It's 5% of that number that Visa grabs. So it's no wonder these credit card companies make a ton of money, huh? So let's take a look at it. On a sale of $100 plus sales tax of $5, the credit card fee at 4% would be $420. Isn't that interesting? $105 is the number to use times 4%. So let's take a look at this. These credit card sales, the easy way to learn this, I think, is divide and conquer. Do the sales piece first, do the credits. We sold something for 100 plus sales tax of 5. So we know we're going to credit sales for 100. We know we're going to credit sales tax payable for 5. We take the 105 times 4%, that becomes a credit card expense, and the cash amount is 100.80. The bank credit card expense really should be called, it's a contra account is what I'm trying to say. The credit card fees are a contra account handled in the same way as sales discounts and sales allowances. Your income statement is going to show sales $1 million. And then the next line, you're going to see less sales returns and allowances, less sales discounts, less credit card charges, okay? Bank credit card sales, it entails a 4-line entry. Okay, I think we know how to do these, but we'll go over them here. Journalizing cash receipts. Well, now we're collecting all this money. We're collecting money from Enrico and Brenda and Edith, and those are without sales tax. We have cash sales, which did include a sales tax number, and we had credit card sales for $22,500 plus a tax of $1,125. And the bank credit card on these sales are $900. They're giving us the number, okay? They're giving us the number. It looks like it's 4%, if I did the math right on my head, okay? So let's see what we have. Journalizing cash receipts. Guess what? You're going to debit cash and credit accounts receivable. Debit cash, credit accounts receivable, debit cash, credit accounts receivable, debit cash, credit accounts receivable, okay? Uh-oh. Uh-oh. Oh, come on. Let me just move up, come back. Okay. Here we have a sale, a cash sale, debit cash, credit sales tax payable. And here is our credit card sale. I would recommend you do the bottom 2 numbers first, the credits. You know, leave yourself 2 lines for the debit piece and do the sales first. The sales is going to be a hard number. They'll give that to you. The sales tax payable, in this case, is $1,125. So we add $22,500 plus $1,125, and that gives us $23,625, right? $23,625. And it's that number they're going to multiply to get the $900 credit card fees and the cash at $22,725, okay? And now they're just showing you how you, excuse me, how you post the sale, the cash receipts. Cash. Here is the debit to cash for $1,596 for Enrico and $462 for Brenda. There's the accounts receivable, and take a look at their account. This guy only had a balance of $1,596. Now it's down to 0. He just paid us. Same thing with Brenda Myers. And again, the total of these ledger, account subsidiary ledgers has to equal the control account. And then finally, I guess, the month is ended and we're going to prepare a schedule of accounts payable. The subsidiary is one thing. We're now going to take that subsidiary and turn it into a simple listing of all of our customers and how much they owe us. That's all it is. The schedule of AR, prepared to verify that the sum of the accounts receivable ledger balance equals the AR balance. It says in alphabetical or numeric, typically alphabetical. I've never seen it any other way. And you prepare it at the end of the month. And the total calculated in the schedule is then compared to the AR and the general ledger. And hopefully they agree. And take a look at it. This is pretty easy. Schedule of accounts receivable. Helen Avery, 2302, 651, 356, etc. And it adds up to 14,331, which needs to be the balance of accounts receivable. And again, the auditors are going to come in here. They're going to verify, first of all, what your general ledger says your AR balance is. Then they're going to look at maybe this schedule next, and they're going to pick out a few of these guys, and then they'll go into the subsidiary ledger and pick out specific invoices. And they'll make you pull the invoice. They'll double check everything. They'll contact the customer through you to verify that the customer agrees that the customer owed you the money at that time. They'll verify the subsequent cash receipt, and they're going to do that for key items in the ledger, part of the sampling process, okay? Finding errors, again, I'm not going to worry about this. If you have errors, you got to re-add things. And that is the end of our chapter. So I don't think this chapter is a buzzsaw. Our next chapter, chapter 11, is the reciprocal of this. It's on purchasing. It's on the purchasing side. So what we're calling a sale in chapter 10 is going to be a purchase in chapter 11, and a lot of rules are the same. Purchase is a little more complicated, but not too much, okay? Anybody have any questions? No comments, huh?
No, Professor.
You good, Mark?
Yes, sir.
Okay, I guess we'll call it a meeting then, okay, guys?
All right. Thank you, Professor.
You're welcome. We'll see you Friday. Bye-bye.
All right. Bye.